indices, Nifty IT and Nifty Bank, underperformed in today's session. They were both down in the red. PSU banks also saw some correction. On the other side, FMCG pack as well as the auto names continue to outperform. So for FMCG, perhaps it seems like there is some festive cheer as we step into the festive and the wedding season. Yes. So perhaps there is some bullishness.
And also, when there's so much volatility, there's no much uncertainty. These kind of stocks, the FMCG stocks, are the good hedge against all kinds of volatility, isn't it?
Definitely, they are a defensive play. But also, if we look at the FMCG basket now, inflation, which has remained elevated, is a cause of concern for the FMCG stocks. But what we have seen is moderation in prices, and as far as inflation goes, the concern remains as far as the fuel prices and the food prices go. Apart from that, core inflation has eased on a month-on-month basis, so perhaps we won't see any sort of margin pressure when it comes to FMCG stocks.
Right. That's the word coming from Suyash, our very own stock expert. We have Mr. Avinash Gorakshakar, Director Research, Profitmart Securities, now joining us live on the broadcast. Avinash, as always, great to have you on the show. Talk to us, your take on the markets, opening flat, closing flat, not the first day, won't be the last day, at least for the near future, isn't it, Avinash?
Yeah, I think, Krishna, clearly today's market was a very lackluster session. And I think right from morning, the markets were clearly indicating that not a very significant rise was expected today. And as Suyash rightly pointed out, I think today banking stocks were clear underperformer. The bank Nifty was also down by almost 140 odd points. So I think, there was hardly any momentum across large caps. And I would sense that maybe the markets are clearly in a, in a kind of a no uncertain kind of zone, because clearly the September 23rd RBI policy is now the near-term trigger for the markets. After that, obviously, the result season would take over. But I think broadly, we are not going to see any major movement on the index on the upside, considering the fact that FIs have been regularly big sellers, on the Indian markets. We'll have to wait for today's numbers also. But I think broadly, till the time FIs stop their selling, the markets are unlikely to move up in a big hurry. So I think it's going to be a stock-specific rally. Stocks like Larsen and Toubro, stocks like Mahindra and Mahindra, typically, these large cap stocks attracted a little bit of buying from the institutions and some HNIs. I would believe that, it's going to be a stock pickers market, and clearly now easy money is gone. So I think investors will have to take a longer term call when they, reallocate their portfolios.
Right. Have a long-term call and reallocate portfolio. Stay with us, Avinash. You're talking about stock-specific action. Suyash, clearly that's the flavor of the markets in the recent past and today as well. Stock-specific action. Talk to us anything that stood out in trade for you today.
Yes. So among the gainers today, Krishna, there was a clear theme that was playing out. Now, two-wheeler stock, which was under pressure in the beginning of the financial year amid concerns about, recovery in demand, which was tepid as we saw in the Q1 results, as well as inflation. Now, they seem to be turning around the corner, as most, at least Bajaj Auto and Hero MotoCorp, as far as they go, they have rallied about 10% or to 14% in the last month or so. So among the top gainers today was Eicher Motors. Now the stock was up about 2.5% in today's trade. Now this was on the back of a bullish call from Jefferies. Now Jefferies, which has a buy rating on the stock, has raised the target price on the stock of Eicher Motors to 4,150, which implies an upside of about 20% from today's closing price. Now the previous target was about 4,000, so they have hiked the target price on the stock of Eicher Motors by about 150 odd points. Hero MotoCorp was another two-wheeler stock that was in the news today. It was among the best performing blue chip stocks and was among the top gainers in the Nifty pack. The stock was up about 2%. Now another stock was Bajaj Auto. Now the stock has been rallying for quite a while now. In the last 1 month, the stock has gained about 10% or thereabouts. So good performance we are seeing from two-wheeler stocks, Krishna, over here.
Right, two-wheeler stocks are doing well. Eicher Motor, Hero Moto, Bajaj Auto. Indian economy is clearly on two-wheeler strides these days. Avinash, I want your thoughts on some of those stocks in action for the day, which is a lot of two-wheeler stocks. Are you witnessing any kind of a trend pattern that speaks to you?
Yeah, I think as far as two-wheeler stocks are concerned, Krishna, I think clearly there's a lot of momentum in stocks like Bajaj Auto, Hero MotoCorp, and even TVS Motors. Of course, Eicher Motors was up largely because of the Jeffries report today. But I think ground reports clearly suggest that this festive season is going to be a very good season for most of the two-wheeler companies. A lot of new product launches are expected by all the major players, and I think margin pressure has slowly subsided. Volume growth is kicking in, and with new product launches, I think you could see a lot of traction, in the second half of the financial year post September. So I think this Diwali and this festive season would be a lot better for these companies because, as Suresh rightly pointed out, this was one segment which had underperformed the automotive market in a big way. We had stocks from the passenger car, from the tractor market, utility markets doing very well, but two wheelers had lagged behind. But I think now things have started coming back. Inventories in the system have come down, and I think demand is quite robust. So I think you could probably see a lot of action in Bajaj Auto, Hero MotoCorp, considering that these companies still command valuations about 15, 16 times 1 year forward earnings, and that definitely presents a decent risk reward for investors who want to take positions here.
Now, keeping it with the two-wheeler stocks, as you rightly pointed out, that Hero MotoCorp is one of the stocks. Now, the stock has been under pressure lately, and there are other stocks like Eicher Motor, which has also not, underperformed the Nifty Auto Pack. So, do you see both these stocks perhaps taking, rallying from here on, considering that Bajaj Auto and TVS Motors have seen a significant run-up in the last 1 month or so? They have given about, double-digit return, both the stocks.
Relative valuation, Hero MotoCorp definitely looks attractive because I think they have been making a lot of effort on introducing higher end bikes. They've also invested a lot of money in electrical bikes. In fact, they've invested a lot of money in Ether, which is one of their joint venture investments. So I would believe that a good monsoon, a good rural demand would obviously benefit Hero MotoCorp the most, considering that it's got a very large rural market exposure. And typically, there's a lot of, capacity which can be utilized. In fact, Hero MotoCorp has got adequate capacity to ramp up volumes. And hopefully, if the, festive season is very good, then you could see a 12 to 13% kind of volume growth for Hero MotoCorp. So I think in terms of the price and in terms of the risk reward, Hero MotoCorp definitely looks attractive, both vis-a-vis Bajaj Auto and TVS, which have actually, done reasonably well in the last 1.5 months.
Now, Krishna, also let us talk about the losers in today's segment. Now, among the top losers in the blue chip pack was Cipla. Now, Cipla stock has continued remaining under pressure. The stock corrected about 1.3% in today's trade. In the last 5 days or so, the stock has corrected about 7%. Now, this was on the back of US FDA carrying out an inspection at a manufacturing facility belonging to one of its subsidiary. Another stock which was under pressure today was Tech Mahindra. In fact, it was the second biggest loser in today's session. It was down about 1.3%. Now, Tech Mahindra, I think, is under pressure because of a broader weakness that we are seeing in the play out in the IT stocks. Now, remember, IT stocks were staging some sort of a comeback, but ever since, the hawkish policy came out from Fed, which suggested that perhaps a higher interest rate regime may stay on longer. We have seen some correction in IT counters. Now, Tech Mahindra actually was one of the outperformers in the IT pack. The stock had rallied about 8% in the last 1 month or so. In fact, last week it touched a 52-week high of about 1320 on both BSE and NSE. So perhaps some profit booking was expected to take place. IndusInd Bank was another loser among the top blue chip companies today. It corrected about 1.5% in today's trade. In fact, actually about 1.14% in today's trade. Now, the stock also witnessed some selling pressure. It is down about 3.5% in the last 5 days or so. But among the private sector banks, IndusInd Bank has been an outperformer. If you look at the year-to-date returns, Krishna, the stock is up about 40%, whereas the Nifty banking index is up just about 3%.
Right, those are the top losers. Avinash, anything, the question here is that everything that was a top loser for the day is against stock-specific action that really took it, very difficult to identify a larger trend, would you say?
Yeah, exactly. I think my sense is, IT continued to underperform, the banking stocks continued to underperform, and of course, Cipla was a stock-specific case, largely because of the US FDA related issues. And considering the fact that, earlier there were some reports that some strategic investors were going to buy a majority equity portion in the company, even that topic is now gone on the back burner. because of valuation concerns. So I think broadly, I think the banking pack has been a clear underperformer. I believe both the PSU as well as the private sector banks were unable to, gather the momentum, and we saw the broad bank nifty also down quite significantly today. On the whole, I think I would believe that, the markets really require a near-term trigger in terms of possibly, some sort of positive surprise coming in from the RBI policy. I think what kind of commentary comes from the governor. But I think broadly the markets are looking at now earnings to, take over. Second quarter numbers, once they come in, I think the markets would gather more momentum. But till that time, Krishna, it's going to be stock specific. We are positive on autos, auto components, specifically on, the capital good companies, where we believe that any correction in the market is a good opportunity to add to your portfolios.
Now talking about the banking stocks being under pressure, one of the stocks that was not under pressure and actually seeing a kind of a rebound is HDFC Bank. Now the stock corrected a lot last week on the back of the management saying that there are perhaps some overhang for the stock in the next near to medium term, given that after the merger with parent company HDFC. But now we are seeing some sort of a buying interest playing out in the counter at lower levels. So Avinash, my question is simple: is HDFC Bank a stock that and a short-term a trader can consider at this point in time, or perhaps or maybe it is an avoid in your opinion?
No, I think, Suresh, in the near term, that is in the short term, I don't expect any major trigger because recently, as you must be aware, HDFC Bank had called an analyst meet, and I think they were very clear on the fact that the initial merged entity numbers were not going to be very encouraging in terms of the ROE, in terms of the asset quality. Our sense is that obviously post September, when the consolidated numbers are presented to the analysts, there could be a little bit of disappointment because this merger is going to play off only in the longer term. So I think from a trader point of view, there are no near-term triggers in HDFC Bank. Yes, from a longer-term perspective, if the stock corrects, I think it would be a good opportunity to accumulate, because I believe that the compounding I think effect in HDFC Bank, which has been seen over the last almost a decade, is expected to continue even on the consolidated entity base level. But yes, it's going to take a long time. So I think traders can not expect much upside in the very near term. But for investors around 1400 odd levels, this could be a good entry point for a reasonably good risk reward over the longer term.
Now, do you expect this narrative of higher interest rate for longer, being an overhang on the market, or has it already been priced in? I mean, we saw a correction of about 2.5% in headliners last week. So is it already priced in, or can we expect more correction because of it going forward?
No, I think this has already been factored in largely, Suresh, but I think the kind of commentary which the governor gives on the inflation, base point number, because I think crude prices have been rising. The monsoon in the month of August was not encouraging. So I think all these clearly data points point out that as soon as inflation is going to be, cooling off, I think that would be a point where the markets would take this as a big positive plus. I think despite higher interest rates, we've been seeing that banks are looking at very strong disbursals on housing loans, on real estate kind of financing projects. So I think rising interest rates is not a problem, but yes, I think a higher interest rate kind of trajectory will definitely be a little risky factor, considering that crude prices have also now started inching up towards $93, $95 a barrel. So I think we'll have to wait for a couple of months before we actually get a clear signal.
Now, Avinash, foreign institutional investors have largely remained on the sidelines. In fact, they have turned net sellers this month. Now, some of the analysts that we spoke to on the show have opined that, perhaps they are missing out on India's growth story. But at a time when, US bonds are at a 16-year high, dollar index is at a 10-month high, is it really rational for us to expect that foreign institutional investors will return to the markets anytime soon?
Yeah, I think it's a very tricky question, Suresh, but I think my sense is that India is a growth story which no FIs can ignore. In the near term, the currency factor will play out. I think if the rupee continues to depreciate, I believe the FIs would be a little wary of putting in fresh money in the Indian markets. But I think longer term FI money would definitely come in. I think probably the next 6 months are going to be very challenging, because whenever elections come in, most institutional investors, including FIs, become a little patchy and markets turn volatile. So I think probably you'll see a bigger flow of FI money post the March, April general election, when things get clearer, and I think there's a lot of certainty in terms of policy and in terms of economic growth. So I think till that time you'll have to see outflows from the FIs. But I think to that extent, the domestic funds are making a good effort in ensuring that SIP flows are generated to the market.
Now, Avinash, inclusion of government bonds in JP Morgan's bond index is largely being viewed as a big positive for both the bond market and Indian economy at large. But do you think that it opens up India's fiscal situation, especially for a greater scrutiny, especially given the fact that among the 20 countries that the index tracked, India's fiscal deficit at 8.9% of the GDP remains the highest?
No, I think in the very near term, this data point would be a little bit of pain point for India. And I think you rightly mentioned that this entry into the JP Morgan bond index is definitely a good sign. I think over a period of time, I think markets would stabilize. And I think obviously looking at the future macro numbers, Suresh, I think things would gradually improve. So I think in the very near term, this the high fiscal deficit number is a pain point. We'll have to see how things move on up to next March. But definitely, I think the entry of India into this bond index is a positive sign. It will give a bigger breadth and a bigger kind of exposure to the Indian bond market.
All right, Avinash Gorakshakar there, wrapping up the day's trading session for us as always, as so often he does over here on the show on Business Plus. Avinash, great having you on the show as always, and hope to keep having you again and again. And of course, Suresh, thank you so much for putting the day's market session into perspective. And with that, we wrap up our market coverage essentially of the show. But moving on to the big debates or the big stories that we're tracking on this afternoon edition of Business Plus. Now, big unlisted companies of India. Another way, big mature startups of India are all set to come under the scanner because there are reports coming out that the Ministry of Corporate Affairs of India is mulling new stricter regulations for the big unlisted companies of India. And what is being said is that these companies, which don't have any disclosure norms because they're not listed in the stock markets, will now be asked to do regular financial reports and, more importantly, submit quarterly financial statements. And that's because the Company Law Committee, the top advisory panel that advises the Ministry of Corporate Affairs, the Company Law Committee is mulling this move to make big listed companies compulsorily submit quarterly financial statements. This Company Law Committee, bear in mind, has some top experts, the likes of Uday Kotak, Shardul Shroff and TK Vishwanathan are part of this Company Law Committee, which was instituted in the year 2019, and it was the term for this particular Company Law Committee was extended up until September 2024 this year. So, what will the Company Law Committee do when it comes to regulating the big unlisted companies, the big mature startups of India? And all of this is being discussed primarily because of all the news coming out from the big startups in the country like Byju's, which has found itself in so much trouble for governance and compliance and financial reporting issues. It's yet to file its audited statements for the last 2 financial years. So, will these latest moves rein in all these big unlisted companies, or will it make it difficult for these big unlisted companies to do business as usual as before and keep growing as quickly as before? That's the question we're asking. And to answer those questions, we have Mr. Shriram Subramanian, founder and MD InGovern Research Services, joining us live on the broadcast. So thank you so much, sir. And of course, we also have Mr. Siddharth Pai, founding partner 314 Capital, joining us. Siddharth, thank you so much for being with us on this broadcast. I'm going to begin with Shriram. Shriram, sir, talk to us. Clearly, this news, for now, there is no confirmation. These are reports from sources at the Ministry of Corporate Affairs of India, where it's being told that its main advisory council, which is the Company Law Committee, is going to make it mandatory for quarterly financial statements. That's one of the moves. But clearly, there was that vacuum when it comes to regulating big unlisted companies in a country which has seen such a big startup boom, and it has delivered unicorns by the hundreds, and now we have decacons by the 10s and 20s in this country.
Yeah, thank you for having me on the show. And firstly, whether there's a need for regulating big private limited companies or big unlisted companies itself is something that probably the committee has looked into. Obviously, a lot of it is derived from the UK Companies Act, which has this definition of large unlisted company. I think probably the Company Law Committee is also thinking of that. But to be, my opinion is that we already have too many regulations. The Companies Act is a fairly detailed regulation, and it also undergoes almost 100 changes a year. So in that sense, it is already a huge compliance burden. The current regulations itself, if they are sort of, I would say, regulated and strictly enforced, that itself would be a big thing, I would say.
All right. Well, so those are the initial shots fired. Too many regulations already. Do we really need one more? So clearly, Shriram Subramanian saying that there is no vacuum as far as regulations concerned. Siddharth, my only question to it is this much. With the current set of regulations, we've had instances like Byju's come up that affects all kinds of stakeholders. The customers, which is the common people, the employees of Byju's, which is again the common people, and of course, what does it say about the startup culture here in India? So there have been missteps when it comes to financial reporting of big unlisted companies and these mature startups. Bear in mind, SEBI chief, Mr. Tyagi, had recently spoken about the need to regulate these big mature startups. I'm sure it's a very thinly veiled reference to the likes of Byju's, isn't it?
I think the one thing I would be very cautious about is not to extrapolate larger trends from isolated phenomena. Yes, the Indian startup ecosystem has suffered through four or five large cases of governance issues, misreporting, lack of reporting, etc. But to contextualize it, there are over 1 lakh startups actually registered with DPIT and several thousands more which have either graduated from the DPIT definition or may not have actually registered as of now. A number of them have actually been continuing operations despite everything that's happened in a fairly structured manner. I think what's important is to understand that a private company is actually private. It's only for certain select shareholders, and they need to be able to decide the governance rules as well as the means of operations amongst themselves itself. I think if the larger public is not actually interested in these particular companies, then the need to over-legislate them is something that this council will actually be examining in greater detail itself. We already have enough provisions under the Companies Act as of now in order for an agreed shareholder to actually reach out to the NCLT, to reach out to the registrar of companies and to actually seek redressal of any of the issues that they have. And they also allow through the articles of the company as well as through contract for a company to actually decide what its reporting cadence has to be in addition to whatever the statutory compliances that are actually required. I think the biggest problem we have is not the lack of regulation, but actually the enforcement of these particular regulations. In case a shareholder goes to the NCLT, it may take a substantial period before they end up actually getting any sort of relief for that matter. So I think we should be wary about extrapolating these kind of trends. There is a need for regulation, but the regulation should actually be driven by the primacy of contact as opposed to trying to create a solution which is one size fits all. Because also it's very important to understand certain companies choose to actually remain private despite their scale. For that matter, because they don't want to raise external money. They want to actually keep the operations within a group of a select group of shareholders or investors, and they should be allowed to do so. I think for these private companies as well, who don't want to actually share their broader financials with the rest of the market, purely because some of their competitors may get access to it, they may understand pricing, they may understand some of these elements. I think that there is also a risk that this committee should also take into account before they end up actually issuing any sort of notifications or issuing any sort of report on this matter.
All right, Siddharth, stay with us. I see Shriram raising his finger. I'm just going to come to you, Shriram. But the thing is that the one point I want to make at this stage is, you were talking about one size does not fit all. Clearly, in this case, the size is mentioned. This is not about the medium unlisted companies or the small unlisted companies. These are the big unlisted companies, big mature startups. So there is a size that is being prescribed over here from what I understand. The other thing I want to ask is there's a specific a line that has come with all these reports, and that is quarterly declaration of financial reports, which listed companies have to do and unlisted companies don't have to do, isn't it, Shriram?
Yeah, so that's what I was adding to Siddharth's point, that actually much of the financials and other details are actually in the public domain, because we reported to the ROC and it is on the MCA portal. One just has to pay 100 rupees to download, right, for all the private limited companies, including the tiniest of companies, the directors, including the PAN of directors, and all other details are available in the public domain, essentially. Only that the timing, as you rightly said, they are probably trying to make it quarterly disclosures or quarterly filings rather than an annual filing as is now. But I don't think that is going to impact. See, if a large unlisted company is wanting to adopt better governance standard, is wanting to move towards listing, etc., it would naturally adopt some of these best practices or move towards, I would say, quarterly filings, etc. Many of these companies, as Siddharth said, do not want to be listed. They want to be unlisted. And so they don't care. Like, for example, a number of unlisted subsidiaries of foreign companies, right? I mean, they will never ever get listed in India. They will continue to be unlisted. And so from that perspective, there is no need for quarterly filings. And so I think we are just going up a wrong, I would say, need.
Okay. Siddharth, I'm trying to rationalize where this is coming from, trying to see where the fear for these kind of regulations, added regulations is, and that is accountability. And you're seeing the fact that most of these big unlisted companies are growing bigger than some of the listed companies in India, and the sheer size of their existence, and the fact that they technically, all said and done, they have lesser accountability as compared to a listed company, is what is sort of pushing both the SEBI, which is mentioned this about corporate compliance norms and governance norms in big unlisted companies as part of SEBI's annual report was mentioned, and now you're hearing that the Ministry of Corporate Affairs wants to step in as well.
No, that's actually true. There is a degree of stakeholder accountability that these companies actually have. Because now the question to actually answer is this accountability best served by actually issuing your financial statements on a quarterly basis for the entire public to see? Then after a certain point, there is no actual difference between a private limited company and a public company, for that matter, even a large private company and a publicly listed company. If a large private company has to make the same level of disclosures as a public company without access to public funds, without the kind of liquidity that the public market actually offers, then it will actually cause a number of entrepreneurs to decide whether they do want to undertake this level of compliance burden without any of the benefits of actually being listed. India is still unique in the fact that unlisted companies are taxed at twice a tax rate as listed companies as well. They also need to be accounted for. If the intent of this committee is for these companies to actually give a declaration to the MCA that yes, they have actually filed their statements and they've been published to shareholders, and to actually get a corresponding shareholders resolution, that would actually solve it. But I think, I firmly do believe that in case these companies are actually meant to open up their books to the wider public, for that matter, then it's better for them to end up actually consider listing as opposed to allowing them to remain unlisted itself. I think these are choices that are determined more by the entrepreneurs and the board of directors as opposed to being driven by statutory compliances itself. So a fine balance has to be maintained between accountability as well as a responsibility to stakeholders, as well as the ability for private individuals to end up actually carrying a lawful enterprise in a manner that they actually deem fit. So I think these are two things that are clashed over here, and I'm certain that during the discussion papers that will be issued, a number of people from industry will actually voice concerns in either one of these two buckets itself.
Right, Shriram, I want to bounce that thought off you. Great point being made by Siddharth over there. It's all about a balance. Even at an economy level, it's inflation versus growth. You have to strike the right balance. In every single sphere of life these days, and every single sphere of economics these days. But same way, with the kind of recent instances, there has to be a balance. How do you achieve that balance?
No, that's what. See, already there are so many regulations which just need to be enforced. That's all. So, do we already there is a need for some of these large unlisted companies to adhere to certain other regulations? Only the MCA quarterly filings is something that probably is missing from that perspective. But if these companies, large unlisted companies, want to move towards better governance, want to be listed in future, etc., they would be on their own be voluntarily putting in place many of these practices of listed companies. And we have helped some of these companies move in that direction. So I don't think there is a need for over thinking this.
All right, Siddharth, I'm going to ask you only one thing at this stage. You're talking about a balance, which is on paper you need a balance. Can you tell us, how can this be done? Because the reason why I'm asking you is very simple. The instance like Byju's, you can call it an isolated instance, but the number of stakeholders, number of sections of society that gets affected by the failure of Byju's own ability to do the correct financial reporting, correct governance, impacts a lot of people and also affects sentiment in a big way. So, to avoid such things, and also to not let India be a free-for-all as far as unlisted companies are concerned? There is a need for regulation, and as you're rightly pointing out, it is also about implementing the existing regulations better than fresh regulations, but you're also talking about a balance. My question is, how do you strike that balance? There are no simple answers to that question.
No, very true, Krishna. If you actually look at it, in case of Byju's also, the Companies Act already states the manner in which the AGM is supposed to be held, how long can you actually extend the AGM for, when you're supposed to file it, etc. And there are several penal provisions that already exist for any contravention of that. But we still had this kind of case despite this sort of affordance built into regulation. Therefore, does adding more regulation really solve the issue? The answer is no. I think the best way to end up actually balancing this is to actually allow the shareholders of the company and the directors of the company to actually come together and decide what the reporting cadence is. If the regulator of the MCA insists that the company actually issues financial statements on a quarterly basis, they should issue it only to the shareholders and intimate the registrar of companies that they have actually issued it to all their shareholders and actually get the corresponding consent from all the shareholders that they have actually received it itself. This way, this sort of situations may not actually end up arising. The need for governance is taken care of because all the stakeholders and shareholders within the company are actually informed, and the regulator can take note that both the directors and the shareholders have confirmed that the financials have been issued and the financials have actually been received. I think we adopt this sort of practice. It solves for that issue without actually giving away private information to the broader market at large itself. There has to be a healthy balance between these two, and the balance doesn't mean that we have to follow exactly what the listed companies actually do. Listed companies have higher disclosures, higher regulatory requirements, because anybody, even with rupees 100 in their pocket, can actually invest in these particular companies. But as you look at the larger unlisted and private companies, even startups, there is a minimum ticket size that's normally needed in order for them to actually get onto the cap table itself. There's a higher bar that's actually placed, and for that higher bar, they actually have a set of regulations that is slightly lesser compared to what the listed companies have. So I think this would be a good way to balance it. There is disclosure, there's consent from all the stakeholders who are involved, and the regulator can take comfort that all the people who would be directly impacted have actually attested to the fact that they have received the financials, and they can ask management what they want. The contracts and agreements, shareholders agreements executed between private equity investors, venture capital investors, and startups already have all these kind of norms. I think enforcement actually becomes key, and more regulation is not going to improve enforcement. Improving enforcement and actually making sure that people can actually seek judicial measures or redressal through the court system in an expedited manner will actually do a lot more in terms of improving ease of doing business and improving investor sentiment as well.
All right. One last word, Shriram, before I let you go. If we were to go through with these new set of regulations for big unlisted companies, do you see a hit impact in terms of sentiment, to open more and more new companies in this country?
No, I don't think that's going to change phenomenally. So obviously, there will be greater compliance burden, but it's nothing insurmountable in that sense. And the opportunity is too large for people to stay away just because of these changes. And these are not going to be so onerous either.
All right, we'll leave it at that. Mr. Shriram Subramanian, founder and MD of InGovern Research Services, and Siddharth Pai, founding partner, 314 Capital. Both of you gentlemen, thank you so much for taking time out to be with us on this edition of Business Plus here on News9 Live. And with that, we shift focus away from big unlisted companies to the diplomatic standoff on the worsening ties between India and Canada. And that is set to have a rather unlikely impact on something that is extremely crucial, in fact, part of our daily life, part of our daily food. I'm talking about masoor dal. That's right, red lentils. Because India, for the last year, financial year 2022-23, imported around 4 to 5 lakh tons of masoor dal or red lentils from Canada, which is worth over 3,000 crore rupees. And now, with ties between the two countries souring with every passing day, there are doubts that we might not be getting all those lakhs and tons of masoor dal from Canada into India. So what happens? Are we looking at a sudden price rise as far as masoor dal in India is concerned? What is India going to do if we're not going to get any more from the prime supplier of red lentils to India, which is Canada? To understand that better, we have a very special guest joining us. We have Shweta Saini, agricultural economist and founder and CEO Arcus Policy Research, now joining us. Thank you so much for being with us, Shweta. There is already now a little bit of fears, although there's information out there that we might get stock which we are not going to get from Canada. Australia could be the replacement. And also, we're understanding that there's already stock that we've imported from Canada that is lying in Indian ports. As of date, Masoor dal is selling in India at 92 to 93 rupees per kilo, if I'm not mistaken. So tell us, are we safe as far as Masoor dal situation is concerned in India?
Lovely. Thank you for inviting me here. It's a pleasure to share with you about the pulses situation. And just a context before we start talking about it, amongst the pulses that we have in India, lentil is the 5th largest crop here. It has about 5% share in the 27.5 million tons of pulses that we produce. If it was a normal year, we're looking at a bumper crop size of lentil in the country today. That's about 1.6 million tons. If we look at the imports figure already, which is since April to August in the 5 months, we are looking at bumper imports of about 0.6 million tons, which you've also already mentioned. But this is something that is the level of imports that we've not done in the last 5 years. So overall, what does it say? That if it were a normal situation, there doesn't seem to be much problem with the availability of lentil in the country, which has an annual consumption of about 2.3, 2.2 million tons. So we have enough availability. But again, the year is not normal because we are looking at a year when we're looking at double-digit inflation in the pulses, especially in case of gram, where the monthly momentum is picking up very fast because of a crop we are told is tiny and enough tracking has been done. Tur dal, both the kharif, tur and urad dals are smaller than last year, and therefore we're seeing double-digit inflation. In fact, if we looked at last year, we're looking at last month, we're looking at a tur inflation of 32%. We're looking at a moong inflation of about 9%. Total pulses is at 13%. So overall, if looked at in silo, it is important that the lentil, the crop this year looks bumper. But there is crisis in other pulses, and therefore we are anticipating that some demand from other pulses, especially tur, would shift to crop like lentil, and therefore we are assessing that the trade already understood this kind of substitution, therefore imported bumper. But yes, Canada is the most important supplier of lentil to the country. We have about 70% of our annual imports of lentil coming from Canada.
70% of all lentils or only red lentils?
Red lentils, for one.
Right, 70% of all red lentils in India come from Canada. Of course, we have other countries supplying other forms of lentils and pulses.
100%. We've got Australia placed, Tanzania for tur, Mozambique, and other countries, of course, African countries support us on other pulses. But in case of lentils, approximately 70% comes from Canada, and Australia is about 1/4. So clearly, as from what it appears, it may not happen that in a current year, where particularly we're looking at an inflation year with very high rates of inflation already, it's an election year. So we do not really anticipate that such kind of restriction would happen, particularly when we are already fighting double-digit inflation in other pulses. So that's it.
I'm trying to make the situation very simple for all those watching us. So the fear is that with all this India-Canada tensions spiraling with every passing day, because bear in mind, all Indian consumers out there, including me, we've just been through crazy tomato prices. And then even the dal prices shot up right after tomato prices came down. So the thalinomics in India has gone haywire in the recent past. So and thankfully, thanks to government intervention, we've brought tomato prices under control. We've got onion prices under control, and there's great domestic procurement of pulses, which has been improved in the recent past, which is also helping us shore up our pulses for the people as well. So the fear for all those watching this, Shweta, is that we hope because of some global geopolitical issues, my Masoor dal does not go up. So so net you're saying that we're absolutely safe. That there's very little chance that there'll be a spike in Masoor dal prices going forward.
So I'll just put it a little differently. I'm just saying we were already in a situation where pulses is undergoing a crisis. So, and if Canada does decide, or that trade does decide to not have imports from Canada, we could see a spike, but I think that may not happen because it is a critical year for the country today. So therefore, I do not see restrictions on these grounds having any additional impact. But having said this, pulses are already in a crisis. But let me highlight one more thing. We needn't have that small a daira of thinking. Now, you may actually be looking at importing and therefore importing and dumping in the domestic prices to ensure that the prices stabilize. But you need to understand that we are in the season where the next crop will get sown. So if imports land in India at very low prices, the incentive to grow the next season reduces. So while the country or the government is walking that tightrope where it has to ensure that consumers get it cheap, it also has to ensure that the farmers' remunerative incentives continue. And therefore, I think it's a tricky balance that the government does. So in case of pulses, they've maintained an open import policy. And it is an election year. We anticipate the prices may not rise as much. But because we are an agriculture economist, we also wish to ensure that the landed price do not reduce the incentive of the farmers to sow lentil in the next season, which I don't see at the current level of prices is going to happen. So clearly, pulses is under a little threat, but it was any which ways even before Canadian crisis happening. But in case of lentils in silo, the situation doesn't look too bad.
Right. And it's interesting we discuss the masoor dal, Shweta, because just a few weeks ago, the question was on tur dal, which we import from countries as far away as Mozambique. So clearly, pulses have been under one kind of crisis or the other, all kinds of pulses, on the most used of them all. And Shweta, that's the concern, isn't it? The tur dal and the masoor dal is used across the country from north to south, east to west. The moment you say pili dal, or yellow dal, it's invariably a tur or a masoor dal that's used. So in that sense, there needs to be a longer term strategy to ensure that these supplies remain constant for Indian consumers, irrespective of any kind of global tension that might erupt at any stage.
100%. I totally concur with it. So let's take an example of you cannot have sambar being made from any other dal. So clearly, there is a sticky demand in case of pulses like tur, and therefore, therefore the whole idea of dumping or importing pulses may actually work for a season, but the country, for its nutritional and food security, needs a longer term strategy, wherein we have to ensure that the yields of most of our pulses stay high, the acreages continue, and the remunerative incentive for farmers continue. We cannot happen. So we've written a recent article, me and Mr. Siraj Hussain had written it, and we'd shown how in case of tur, the import dependence has actually doubled in the last 3 years. So, it might just help. And ironically, we still are looking at very high tur inflation rates. So clearly, it's a tricky balance, but we have to ensure that while consumers are being supported, you cannot really be depending on countries like Africa and Australia to be producing pulses for you. It's a staple crop for India. It's important for our nutrition. And therefore, I feel that while consumers' concerns, and including people like us, our concerns are really important. Food inflation has been double-digit, has been high. Even when it started to moderate recent year, it has been building up for the last year and a half. So we are clearly not out of the woods. But to really have the entire burden of inflation on farmers is also unfair. So somewhere government will have to ensure a long-term strategy where pulses farmers continue to produce what they produce.
Right. Shweta Saini, the agricultural economist and founder and CEO of Arcus Policy Research, joining us and helping put things in perspective from global geopolitics to our very own little masoor dal on our plate. Shweta, great talking to you and hope to keep having you on the show again and again. But for now, we'll let go of you because we've completely run out of time here on this edition of Business Plus. Shweta, thank you so much for being with us. And with that, we wrap up this edition of Business Plus. But before we let you go, here's an important programming note here on News9 Live. The big show at 10 p.m. tonight. Duologue with TV9's MD and CEO Barun Das in a candid conversation with former Indian cricketer Mithali Raj. Take a look at this and make sure you catch the full show at 10 p.m. tonight right here on News9 Live.
What happened on 8th June 2022? Sportsperson like Sania Mirza or Saina Nehwal, they get written about more than the women's cricketer.
Journalist, for some reason, doesn't like an athlete. The narrative is very different.
Don't you think that a very, very focused approach should be there to create an ecosystem for producing champions?
There are also some girls, they say like, Didi, school में तो कोई नहीं है हमारा, हम खेलना चाहते हैं लेकिन boys team में लेते नहीं है.
In the huddle, do you tell your team members that let's go and fight, or you tell them let's go and win?
The purpose of you being in the tournament, that you've come to win.
Duologue with Barun Das featuring Mithali Raj. World premiere on Connected TV. Tonight at 10. Only on News9 Live. India's first and only digital exclusive English news stream for Connected TV. Supported by Alliance Broadband.